Nirmal, ladies and gentlemen. I'm Hero Bhatia. We have with us Mr. Indranil Pan, Chief Economist at Yes Bank, joining in. Welcome to the show, Indranil, and always a pleasure to speak to you and get insights from you. Indranil, my first question coming to you is, with what's happening across global economies, inflation is one of the concerns. With that, you have global central banks as well, which are on a rate hike spree and looking to squeeze out liquidity. And we are talking of, the US, the Russia-Ukraine crisis continues. And on top of that, you also have a recessionary phase that everyone is staring at in terms of Europe and US. How are you seeing this entire gamut play out?
It's a very interesting phase that we are seeing in terms of the overall sort of economic progression of the world. Now, if you remember 2008, 2013, when we emerged into economic crisis, it was the central banks who actually saved the financial markets and therefore facilitated the economic growth to actually come back. And therefore, we saw a V-shaped recovery. Unfortunately, this time around, there are two things I think that are happening very critically. One is you are just out of COVID, so strengths of business cycles world over, except for a few pockets like, say, US, may not be good enough. And on the other side, you have the inflation, which is leading central banks to tighten. As you rightly said, the US, but the Ukraine-Russia crisis is still going on, which nobody had expected would extend onto these levels. So the ripple effects of that on the emerging markets are being felt. And to that extent, if you remember in 2008 and 2013, it was the emerging markets who were front runners in growth rather than the developed markets. Here, the emerging markets and the developed markets, in terms of the growth prospects, are actually moving neck to neck with each other. And hence the outlook for growth going ahead looks that much more scary.
Right. So when we say the outlook for growth looks scary, what's your anticipation in terms of India itself? What's that range that you're working with?
So right now we are at a 7% in terms of our GDP number. But having said that, there can be a lot of downside risks to it, because when we did these numbers, we were actually not factoring in a 6% plus and closer to 7% inflation that will have its negative implications on the private consumption demand. So that is something that we are seeing. We were anticipating some amount of rate increases to happen, but not all the way to a 630 or a 640 level as we might be anticipating at this point in time. So overall, the strength that one would have expected post-COVID in terms of the private consumption demand to ramp up and therefore sort of pull India's growth is possibly absent. That's point number one. Point number two is a lot of literature does point out to the positive effects of the export growth. But having said that, one forgets that we have an import also, which is quite elevated, and therefore the trade gap and the current account gap, something that we actually incorporate within our GDP calculations. So the net trade is likely to be a drag on the economic growth for India. So the only standing soul possibly is the government, and how government's expenditure actually sort of drives the infrastructure demand and therefore employment and et cetera, et cetera. Given the tight fiscal conditions, very little hope that the government will go beyond the fiscal numbers as they have put out in the capital expenditure sheet. But even more important to note is that in future years, the capacity for the government to increase capital expenditures may be significantly muted, because the redemption pressures of government securities will be high. The turn in the interest rate along with the higher debt GDP ratio could impact the interest expenditures of the government, and that's what would possibly take up a lot of space within the fiscal, leaving limited room for the government to ramp up capital expenditures in future years. So that, I think, is the critical worry as we see India in its current growth juncture.
Right. And with this growth number said and done, are we saying that in FY23, 6.3, 6.4 is the range that we should look at in terms of RBI increasing rates?
Yes, so the point that we are looking at is that from an average perspective, if RBI has painted 5.8%, and they are looking at a neutral rate or a natural rate at around 0.8 to 1%. So you possibly need to build up a little bit of a buffer over the 5.8% average inflation that they are looking at, which easily takes the repo rate to a 6% plus. Having said that, I think the inflation dynamics are quite significantly volatile at this point in time. And along with that, recessionary risks that are building out in the world is leading to commodity prices to sort of cramp lower. But having, again, on the other side, you have the depreciation pressures, which are a source of concern. So all that taken together, a 6.6 to 6.25 in terms of the repo rate by December looks a likelihood. I am not calling it a terminal rate or anything because there are so many moving pieces at this point in time. But we do expect a pause from the Reserve Bank of India thereafter, assess the growth inflation implications of the higher repo rates, and then sort of take the incremental decision from there on.
Right. And with this, how major a concern could inflation be?
Well, I think my personal feeling is that inflation, yes, inflation had gone up to 7%, higher than the threshold levels. But in my perspective, inflation concerns for India may be relatively lower than in the Western world. And one of the major reasons is that the government have also stepped up its fight against inflation. For example, a reduction in the customs duties on edible oils, a stoppage of wheat exports, which has also brought down the wheat prices. You have a relatively decent monsoon till this point in time. Kharif on the rice side is looking a bit weak in terms of the acreage, but otherwise oil seeds, pulses are doing good in terms of the acreage. So all that taken together, and given the fact that 47% of my CPI is still food, it provides a little bit of buffer in terms of how we factor in inflation at this point in time. The second is, yes, the crude oil is volatile, but if I'm looking on the pass-through side to the pump prices, from May 21st, the government has not really passed through anything in terms of the higher crude oil prices or even the depreciation of the currency to the end user. So that is the point that I'm trying to make, that the fight that the government is also putting up along with the Reserve Bank of India to contain inflation pressures is important. And therefore, we see the direction of the inflation having already changed. And that's possibly the first thing that the RBI would have looked for and have probably achieved.
Right. And what is the number that we should be working in? What are you estimating?
So broadly, the average for the year, we are working with a 6.6 to 6.7%. With the fourth quarter closer to the 5.7, 5.8% as an average inflation number is what we are working with at this point in time.
Right. And overall, if you see in terms of the fiscal deficit side of it as well, as you already mentioned, one, there could be pressure in terms of the government capex capacity as well. How do you think would be the best way? Because clearly, the governments have also come out and said that they need to manage subsidies in a targeted manner to contain the fiscal deficit. So how are you viewing the fiscal deficit side of it, and what, again, are the estimates looking like?
So it's very difficult to talk about the fiscal because we have data only for 2 months. And as anything else, given an uncertain year and where we are significantly talking about the government taking the lead in terms of managing a lot of risks within the economy, fiscal calculations at this point in time can go horribly wrong. But having said that, if I factor in the known knowns in terms of the fertilizer subsidy increase, the food subsidy increase, the loss to the exchequer because of the excise cuts on petrol and diesel, and also add back the delta that the government would be hoping for in terms of the windfall taxes, etc. Our feeling at this point in time is that there could be a slippage of about 40 to 50,000 crores. Let's not also forget the fact that the nominal GDP would be a pretty healthy 17% odd compared to the 11.1% that the budget had been working with. which necessarily means that the tax collections would significantly overstrip budget estimates. And that I think is the biggest sort of or rather a buffer that the government has already built into the fiscal calculations. So it's about a 40 to 50,000 crores of a slippage is what we are looking at this point in time, but unlikely to sort of lead to additional borrowings, because I think to a certain extent these levels of deficit can be managed through cash drawdowns of the government, as well as a likely higher savings collection or a small savings collections, because the budgeted small savings numbers are quite lower than the achieved numbers of the last year. And in an atmosphere where equity markets are shaky and also interest rates are going up, there can be a preference towards fixed income instruments, including those of the governments.
Right. And simultaneously, in terms of the rupee as well, the weakness in the rupee will drive up the cost of external borrowings as well as hedging for domestic firms, right? So how do you see that mark paying in? Because we've already breached that 80 per dollar psychological mark now.
Yeah, so we were expecting the rupee to depreciate. We were, however, expecting that 79.50 is something that we see by end March 2023. Obviously, we were wrong on that, as we did not possibly anticipate the inflationary pressures in the external world, especially the developed economies and the aggressiveness that we are seeing over there. My next concern for the rupee, I think the concern in terms of the monetary policy cycle from the Western world is over. My next concern for the rupee, very honestly, is China and the problems that we have in China, whether and how much it will lead to a CNY depreciation, and the ripple effects of that will be felt through the Asian region into India. So we still look at a depreciation pressure in INR going to around, say, an 81 or somewhere by end March 2023. Having said that, I think the RBI still has adequate amount of reserves, even though the import cover as in terms of number of months have been coming down. So there could be some amount of sort of concern over there. But broadly, I don't think the reserves and the adequacy of it immediately is a huge concern. The good thing, however, is that, as you rightly said, the ECBs and everything will be more expensive. So that, to a certain extent, provides an opportunity for credit growth within the country. And that is possibly also, as you are seeing, credit growth in terms of the banking sector numbers. The credit growth has actually, in terms of YOY numbers, have outstripped the deposit mobilization of the banking sector. And that is the positive side of the story to the currency depreciation.
Right. So in terms of credit growth, again, everyone's anticipating great numbers on that front. What number should we be working with? Because we've been speaking about a double-digit growth. Firstly, is that a number we should be working with? And secondly, where do you see this growth coming from?
So very honestly, credit growth numbers are a little difficult to analyze at this point in time. So if I really see the macro data, yes, credit growth numbers are closer to 12%. And my belief would be, to a certain extent, it would be more to do with working capital requirements as the input cost pressures have built up, and manufacturers need to have a relatively larger credit numbers to manage their raw material inventory. So those could be one of the issues. Secondly, yes, the RBI is hopeful that private capex builds up, but I think 74% in terms of capacity utilization may not be a good enough number. Historically, 80% plus is something that pushes up your capacity utilization. But some of these analyses, however, had been happening before inflation had hurt us and moved to 7%, which necessarily also means to say that to a certain extent, the expectation that we had in terms of the credit pickup through the personal loans, etc., could also die out, because the overall personal expenditures could actually be coming lower. So taken together, I think credit growth broadly should be in the 10% zone for the year as a whole. Liquidity is tightening, so that will provide a boost to or a trigger additional deposit sort of raising by the banking sector and the intermediation sector in the country. So gradually, the deposit side in terms of the rate of interest should catch up with the lending side story. The other sort of important thing is, for example, if I really look at the industrial segment, credit growth has been more going towards the small and medium, which is again sort of the CEC, LGS, and the extension of that is helping. The large industries are not really pulling credit at this point in time, and that however is a worry in the sense that if I'm looking at investments per se, it has to be the larger corporates who have to pull. But either the larger corporates don't have necessity in terms of fresh capacity buildup, or their internal cash generation continues to be adequate if they are building out capacity.
Right. And with all of this said and done, and really my last question coming to you is in terms of the bond yields. As the rupee has been falling, the spread between the Indian and the US bond yields is tightening as well, right? So how do you see the bond yields panning out in terms of the Indian markets?
It's a bit of a sort of chicken and egg problem. Yes, we would expect our bond yields to increase and therefore maintain that gap between the India and the US, and therefore pull in capital. But having said that, the risk is that if I try to attempt to do that, on the other hand, the push factor, because US is also raising rates, the push factor in terms of global liquidity finding or hunting yields in emerging markets, that may not be ripe immediately at this point in time. But having said that, I think the other way of looking at it is that the fiscal is not really expanding in a very significant way. And the longer end of the yield curve will be looking at the fiscal and the slippages, and therefore whether we factor in additional borrowings. That's not what I am expecting. The risk is that if yields actually tend to increase at a faster pace, the interest burden of the government in a situation where they are already carrying 90% debt GDP ratio is a big risk, and that will also be in the radar of the Reserve Bank of India, therefore to prevent a very sharp increase in the yields on the government securities.
Right. So I think a little bit of moderation is something that will be needed, and how the government manages that is something that we need to wait and watch. But thank you, Indranil, so much for joining us on the show. It's always a pleasure to speak to you. Great insights that I've picked up today as well, and for the viewers. Thank you. Stay safe and speak to you soon again.
Thank you very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.